Well, good morning or afternoon, actually. So this is podcast number 50, Matt. And today we're going to go over this weekly brief titled The Economic Landing Zone. It's a phraseology that analysts have been using as to where we're going with the economy right now. And
Sure.
looking at where things might go and the results of the Fed's move last year. And, to give a little backdrop to where we are right now is, after the 2020 coronavirus, we had literally billions of dollars that came into the economy thanks to the Federal Reserve, to the federal government, to businesses, and to you and I, and anyone that could qualify for any number of stimulus programs that they put out there. And what that did is it literally had too much money, and at the same time, too little goods, as supply chains and materials and cost and goods just became unavailable, whether it was food, air conditioners, screen doors, anything at Home Depot. It was pretty much all taken up. And so that prompted, obviously inflationary prices going up with the demand on goods and money. And so that led to the Feds stepping in March of last year and starting a very aggressive, one of the most aggressive rate hike policies since the 1980s to slow this inflationary pressure down, which indeed they did. But what that also did is created new concerns and worries that, combined with Ukraine war and the supply chain issues, now we're worried about what the Federal Reserve rate price increase is going to do, and are we going to crash into a recession? And then therefore, here's this analogy of a soft landing, which would be just kind of slowing down, or a hard landing, which is a crash, not a very good thing in aviation terms. And what that might lead is to more issues. And so Jerome Powell and the Federal Open Market Committee started this rate hike policy that now has resulted in 8 consecutive rate hikes since March of last year. Now, what's interesting is how the Federal Reserve and Jerome Powell has been largely second guessed by the investment marketplace. And but their view was the credit markets, the lenders and businesses, had room to slow down, and that they were significantly underpriced, and raising rates would have a marginal, if not any, impact in the economy. And as it turns out, that has been the case. But in the meantime, last year, institutional investors and private investors dumped stocks, sending all the major exchanges into a tailspin, with the NASDAQ dropping the most, 32% last year. And we talked about this last week as well. And you can listen to our podcast last week, or go to our website, upcapitalmgmt.com, and look at our reports last week. So the market dropped. Now it looks like, Matt, that the Federal Open Market Committee and Jerome Powell may be more accurate and be more spot on with their assessment than investors gave them credit. So we now have rates have been bumped up 8 times. Mortgage rates have gone up. Housing market has slowed down, but the energy prices have come down. And we now have almost a near stop of consumer price index going up from last year.
Yeah, I think that it looks like the Goldilocks method, of, not too much, not too little.
Right. Okay.
Maybe they knew what they were doing, which is what we hope, right? So, the Bureau of Labor, they just released our January CPI,
right?
And we had about
right,
half percent slightly above forecast, which is good. We're a little bit up on some of the things like motor vehicle insurance, recreation, apparel, stuff like that. But the nice thing is stuff like used cars, medical care, airline fares, that stuff came down a little bit. So what's nice is, especially with, the driving force of our economy being, us, the consumers, a lot of the big purchases that people may have been scared to commit to, maybe they'll be a little bit more likely to do that now with those things coming down.
Right. This morning, listening to CNBC prior to the market open, we were talking about what is called a super core inflationary. So what they're doing is dissecting the CPI, and their definition of the super core is is the CPI excluding shelter, housing, energy, and food. And that was up 4.3%, which is good news. But I don't know how we're going to live without housing, energy, or food. So I'm not sure how terribly helpful that is. But, you know, in dissecting the CPI, by all standards, it is slowing down. And and if you go to our website, you'll see the chart. And it really pretty much just hits a wall in August, September, and has been barely increasing month over month since. So that's really good. And so the evidence is there. The economy, the price increases are slowing. We're seeing it at the gas stations. Prices are coming down for gas prices. Housing prices have slowed, if not starting to contract. We've talked about that in the past, and so that's really good. So now the question and commentary is really has been void of the idea of a hard landing. So that's good. So now we're at two scenarios. A new one that's just recently come out. We have the soft landing, but the newest one is interesting, is no landing at all. The economy is not going to land in terms of some kind of a stop. So airplanes have to land, but the economy and the decline doesn't necessarily have to.
Yeah.
And
that was because of the labor market reports.
Right.
Okay.
Yeah. So I believe there's a huge underestimation of the power of the consumer, which is odd to me, because consumers and what we all do is 2/3 of our economy.
Right.
And the other third is governments, nonprofits, and foreign investment. And so you take corporate, government, and nonprofits, and then foreign investor, and that's 1/3. What we do is 2/3, and yet everything seems to be focused on, and especially CNBC and other business newscasts and media outlets, is all about stocks and corporate earnings, which is only 1/3 of the four of corporate, government, nonprofit, and foreign investment. So it's interesting. But yes, consumers continue to be very strong, with unemployment dropping to 3.4% last month, the lowest since 1969.
Which is surprising, because all the headlines were saying, layoffs, huge tech layoffs. Google, Tesla, Apple, and Microsoft, they laid off almost 70,000 workers.
Right.
Yet our unemployment rate dropped. That's pretty surprising.
Right. And so what you're seeing is the assimilation almost faster. Actually, it is faster. If unemployment dropped last month, so the assimilation of these people getting new jobs is happening faster than they're being laid off.
Right. That shows how many vacant positions there really were. Yeah,
right.
It's amazing.
Right.
Yeah.
And then another factor is consumer spending.
Right.
Is picked up. Reports that we talked about picked up in January. And I think the decline in consumer spending in December and during the holidays was actually showing some good discipline on consumers' part, that not knowing what 2023 holds and inflation and all the concerns, instead of opening up the checkbook and the credit cards, they actually slowed down spending. So I thought that was good. That was good.
Yeah, especially if people have 3% and 4% fixed mortgage rates all these years. So they have a little bit more money to spend. Maybe they're not planning on buying another house because rates are higher, house prices are higher. They're staying put.
Right.
It's declining energy and gas, and they're gonna end up going and spending a little bit more.
Yeah. So a conversation I had earlier today with one of our clients, very worried about the economy, very worried about the future, and the nice thing about history is that it can be a good guide. It doesn't necessarily guarantee, but it gives us some indication of what's happened in the past. And rarely do I find, when I study history, is there a never before scenario that we've never been through this. And it's interesting with what we've been through these last 3 years, you would think would be a never before experience of a worldwide pandemic, and certainly shutting down the entire US and people forced to stay at home and work at home. You'd think that would never have happened before, but almost exactly 100 years later, from the Spanish flu in 1917 and 1919, it happened. It happened exactly as it did now, with governments requiring people to stay at home and the message. In fact, the Spanish flu was far more fatal than the coronavirus, which is an interesting component there. So it would seem like that if history is an indication, after the Spanish flu in 1917 and 1919, followed 9 very strong years of the economic growth in the stock market. So much so it was referred to as the Roaring 20s. So it happened, and so there can be some encouragement that if it's done it once, maybe it happens again.
Awesome. That's great. Yeah, that's prosperity ahead.
Yeah. So what does this mean to me? So we show some charts on our website of how the S&P 500 technically has really improved quite significantly since December 1st.
Mm-hmm.
And so when we had the bottom of the S&P 500, what we're seeing is when it peaks, that the previous peak is lower than the new peak. And so since October 12th, where we had the most recent low, and then the next low of December 28th, we're seeing higher highs and we're seeing higher lows. And so on our website, we show a chart that with the trend lines clearly going up. So
Right.
Since October 1st, actually October 12th, we've seen a steady rise. And that's, it certainly isn't the end all, but it is certainly encouraging. And currently at today's close is higher than the previous high that we saw. So that's good. The next high goes back to August. And so if we continue this trend, we want, breaching above the previous high in August of last year will be more encouraging there as well.
Awesome. So we're beating our 20-day moving average. We're beating our 200-day and our 50-day, all of them. So
Right.
Does
Right.
this mean no landing? Does it mean we are landing? What do we got going on?
So I would think from what we're looking at and what we've seen in the past, the no landing scenario makes a lot of sense to us,
Okay.
where the economy does slow down. How could it not with rate 8 rate hikes? However, it could hover above a 0 GDP growth and not moving into recession territory, which is negative GDP growth, which is what we had first 2 quarters last year. We could hover right there and then slowly pick up speed through the end of the year. One scenario that seems to be dominant in the media and with analysts is that the Feds are going to start lowering rates, thinking that they overshot with rate 8 rate hikes and probably a 9th one next month, and they overshot and they're going to slow the economy too much, and they're actually going to start lowering rates at the end of this year, 4th quarter. I don't see that. Jerome Powell has never referenced that. That's a scenario that has been introduced by analysts, but never by Jerome Powell. I think they're going to be very comfortable. 0.25% increase on February 1st, probably another 0.25 in March. And I think at that point, they may be comfortable just to let that sit and let the economy assimilate these rate changes, maybe even another rate increase, which would seem, because they really are focused on a 2% inflationary rate, which even with the most favorable reports recently, we're still well above their target. So I see a no landing scenario, and at that point, beginning to pick up speed through the rest of the year.
Okay, awesome.
Well, that's our report for today. We'd love to hear from you if you have any comments about this conversation Matt and I have, and love to hear from you. In the meantime, that closes out today's podcast, and we look forward to hearing more from you. We'll talk to you later. Bye.
Take care.